$DXY is the dollar index, which is more than half weighted by the euro currency. Here you could see the weightings in there. Those weightings are probably a couple months old, so but you get an idea that the heaviest weight by far is the euro, so it's basically half correlated inversely. And you can see the dollar basically on its lows in here. We talked about the big diamond, that the diamond likely being a big top that was forming, and that was clearly correct. It is now plunging down through that major 61.8% fib. We have lowered our target down here to about the 91.5 area. Sometime out in towards the end of the year. That would be November, where that bottom comes in, or potentially early December. So you can see when you look at this, it's really not likely that there's going to be any upside that can hold up until that point out in towards the end of the year. If you look at the cyclical rhythms right in here, you could see that. Now there's a kind of a wider pattern, and there's some out of phase cycles, essentially what we're looking at. But they all come into this nested area. So in other words, they're all three declining into this period, late October to late November. That just says that there's a real potential for really an acceleration to the downside in here. So I'm saying 91.5, that's about another 2% to the downside. It's already down 10%. It could be worse than that. So this is really not good patterns when we look at that, and it's following the analysis very well. Now, this is just running past everything. I cannot get a good read on this right now. It looks to me like long capitulation going on right in here, but it's been going on pretty well past this. So when you get these nearly perfect minor cycles that you see in the dominant patterns that are very much in line, you could see the lows right in here. I'm just going to show you that big dominant pattern made up of the four smaller ones and how it is very, very consistent as we move in here. And what that says to me is that there's something changing in here. So there's likely some kind of a shift going out. And I'm going to need to accommodate for that because this capitulation is taking so long. And we're looking for a rally. Now, the bounce in here probably only gets you to maybe about 94.5 to 95 at best case, and then very likely to be moving down again. You'll notice we see a bounce and not lower lows because that would be the first cycle in this dominant pattern in here, and it's likely to make a bottom rally and then make a higher low. But we're projecting that just based on the highest probability of the patterns. In the meantime, we have to get a bottom in here to form. You could see the momentum in here. When did the momentum turn negative? Well, the slim ribbon went negative over here, and you had the big decline. It went negative again over here, and you had the big decline. So this wave over here was from 96 to 93. That is a huge decline for that brief period of time. When I look at the momentum here on the weekly, the momentum turned down over here at 100 right there, and of course gets all the way down close to 93 today. So the momentum just almost always screams at you and tells you market conditions. And these market conditions in the dollar have been terrible. So we'll look at each of these currencies in here, and you'll be able to see that they're really not set up to give a lot of ground in here, and the dollar's only set up for a minor bounce. Look at this euro currency. Again, it's inverse to the dollar, and the rally has really taken on this last month strongly to the upside. When you gain 4 cents in the euro, that's big. And when the Eurozone said they're willing to start to put together a loan program, well, then the existential threat of the euro currency went away, at least temporarily. And there's plenty of criticism about how the European Union was formed. And with the weaknesses that are built into it, with 26 different countries and 26 different cultures, all of those things, and Southern European countries being massively indebted, it's just a really weak structure. But now if they're going to do like the rest of the world is doing and just print funny money to stay alive, well, then that makes the euro currency stronger. And you can see that that's really what's going on in here. So the combination of the euro the EU working on that loan program and passing it, and the US dollar just being absolutely decimated by our Fed. That combination has got the euro currency moving up very sharply. So we have the pattern in here suggesting that this area here is a top or a temporary top up here at about 118 to 119. We're still going to look at that, but it's pretty reasonable to projecting up to the 78% over here if it gets through that level. So we're going to leave it as it is right now, but then if it gets through that level of about 119, we're going to have to project up to the next level. Based on what we just said to you in the dollar and the risk down to 91.5, what's the probability of holding the resistance here at the 61.8%? Well, it's next to zero. So we really need to look at upgrading this and looking for even higher prices in the euro currency. So here's the daily chart. Those of you that are cycle analysts, there's so many of you that are becoming so. I really love it. When you look at the translation on here and the configuration, it is super bullish. So this is a swamped situation where the upward momentum that you see in here is so strong. Now here's where the momentum turns strong. You can see that you can't even get a buy signal really down over here in the projection oscillator because it is so strong. That shows you the type of internals that you have, and a very, very bullish cycle in here as this went up from 109.5 all the way up here to close to 118 in this period of positive momentum. So just significant. We couldn't even establish a good buy zone in here. The worst case is it probably comes down and tickles the 21 EMA, and then, I'm sorry, that's the 8 EMA, and then begins to move up again. So this is a very, very positive pattern that you see in here, and it just does not speak for a lot of potential for any dollar rebound. So we said dollar rebound to 94.5, 95. This hardly makes the case for that being able to happen, and the dollar might actually be much worse than that. So that's a look at the euro currency. It is not in it's not signaling anything of any kind of a real decline in here. I want to show you the VIX right in here. We're in this period right now where we should get a pop in implied volatilities. When I investigated this in askSlim Live on Tuesday, it looked like the second half of this dominant cycle right in here usually gets you about a 50% increase or more in implied volatilities. That would take you up to about 36. We've been projecting to 45 to 50. Maybe it is only up to about 36, but we don't really know until we actually do get some declines in the market, and then all of a sudden buying insurance is important. Remember, implied volatilities is purely a demand for insurance, and they pay for that insurance through pricing inputs. So there's no move to insure their positions right now, but when they go to do that, you will see this spike up pretty quickly based on this pattern. And when you look at this, this is scary, perfect right here. This says that it's just a matter of minutes to a couple days before implied volatility start to pop again. So again, with the NASDAQ giving me the information it is that it has broken down, and the VIX giving me this is the spot that implied volatilities are likely to start moving up. Well, it has me believing that this rally we're having in the stock market these last 3 days, this is what amounts to a minor bounce after a decline. I don't think it lasts. So I'm just bringing you the sum of the evidence as I put this all together. Remember that it could be wrong. When I bring it all together and I put probabilities on it, to me the probability of a significant decline in the next 4 weeks is better than 70%. And that would put it at 3 times out of 10 this whole analysis will be wrong, but 7 times out of 10 it will be right. And that's kind of where I want to be. And I'm bull bear agnostic. Our whole team is that way. I've been training these guys and working with them long enough to know that we just look at what this says and bring that to you and do our own trading right around that. So some of the evidence here when we look at the stock market is suggestive of the fact that it's got problems. We just basically are not seeing the deterioration yet